Welcome back, and joining us on the show now is Sushant Gupta. He's director at Mackenzie and joins us on the show. Sushant, hi, thank you so much for joining us. And the volatile crude oil markets just about continue, whether it's about escalation or now the conversation about de-escalation of conflict between the Israel and Hamas. How are you reading that? And add to that, the reason that we also are seeing pressure is because US and Venezuela have started to talk yet again.
Thank you, Manisha. Obviously, the market's really fraught between uncertainties at the moment, and both on the upside and downside. And partly, the market are grappling with the fundamentals and the pressure from the geopolitics side. Now, last week we saw the oil prices jumped because the market were concerned about the fear of loss of supply if this conflict escalates further. But we have seen since then the risk premium which was added to the market last week has gone down. And we're closely watching, the international diplomatic efforts, to avoid any further escalation of the conflict. Now, I think on the fundamental side, we still remain of the view that the markets will be tight in the Q4, and we continue to expect prices to be around $91, $92 per barrel for Q4 average for Brent.
So 92 to 94 on an average. I remember from the last time we spoke, you have revised it on the higher side, Sushant. Do you see this spilling over as we begin into 2024 as well? Or do you think Q4 of this calendar year is more difficult? And by the time we start into 2024, things could be better?
Yes, I think we're seeing this Q4 of this year to be much tighter compared to the previous quarter of this year. And as we head towards Q1 next year, we do expect oil prices to slightly moderate because of the seasonal build in the stocks we expect for Q1 next year. So I think the markets will slightly soften in Q1 next year.
Sushant, how are you also reading the conversation between US and Venezuela? I mean, is it just a conversation because there are just too many ifs and buts there?
Well, I think, the supply picture from Venezuela, Iran, whether it's, Iran or Venezuela, I think we are seeing that the US does not want the market to go very tight, and hence the oil prices to reach very high. So in last year, there were some exemptions given to Chevron, to produce more from Venezuela for export to the US markets. I think we could see something similar, but again, and at the same time, US has also mentioned that they will not, tighten the sanctions against Iran or add any additional sanctions as of now. The things are very, very fluid at the moment. If we see, the conflict in the Middle East escalating further, US might change its stand. Right. So as of now, we expect, the supply from Venezuela and Iran continue to rise in our forecast, but not to the same extent, as people would expect, but slightly increases there.
Sushant, also, how are you looking at, the demand side of it? Because supply is a concern, yes, but are you also looking at demand continuing the way it is, weaker from China, lower imports from India?
Well, so the demand overall, for the global, for this year, we're forecasting 2 million barrels per day of demand growth. And out of this, 50% comes from China. India adds around 250,000 barrels per day. Well, there is obviously the Q1, Q2 has been very weak for global oil demand. So we expect a lot of the demand to be, loaded in Q4 of this year. So China adding around 1.2, 1.3 million barrels for demand growth just in Q4 of this year. So we are hopeful that China could deliver the demand growth. Government is doing its, taking all the efforts to get the target level of GDP of 5% for this year. Our forecast is 5.2, GDP growth for China this year. So I think we're still optimistic that we can achieve 2 million barrels for demand growth globally. I think, and compare this to the supply growth, right? We're talking about 1 million barrels for the supply growth globally, right? That's why we are forecasting a tighter market for Q4 of this year.
The final question, Sushant, is on OPEC and allies on what they can do, because they tend to move prices quite a bit. What's your sense on their stance?
Well, I think if you look at, OPEC decided to cut production, back in July. At the moment, at that time, the prices are very weak. Now, in the last 2 months itself, the oil prices have appreciated almost $15 per barrel. There's quite a bit of appreciation, even before the Israel and Hamas conflict started, right? So, as of now, we don't see a change in the OPEC policy. So although the current prices may be a bit higher than what the group would like to see, but they would remain cautious in putting more supply ahead of the demand in the market, because they still remain cautious of the global economic growth. Non-OPEC supply growth this year is 2 million barrels per day, which is almost meeting the demand growth for this year. So they're still remaining cautious in putting more supply back in the market. They would get a chance to put more supply in the market from next year. So we expect OPEC Plus or Saudi Arabia, to put more volumes in the market starting next year.
Okay, all right. Thanks a lot for that, Mr. Gupta, and thanks, Manisha, as well, for taking us through the discussion. Let's do one thing. Let's slip into a short commercial break on that note. Lots more coming up on the other side, so do stay tuned in.